Hey everyone, Rick Alberts with Lamerica Real Estate. Let's talk about buying in 2024 as an investor. Let's get started. Okay, so you may have seen my other video about home buying as a personal residence. Now let's talk about the investment side, right? So you're going in to do short-term rental, to do long-term, mid-term rentals, which is more like month-to-month, right? Someone comes in and rents just for a month. It's gained a lot of popularity, especially during COVID because of all the traveling nurses. So what are some things going into 2024, both locally here in the Los Angeles area as well as out of state? There's a couple of things you need to factor in. One is you might want to consider being ultra conservative on your numbers. Why do I say that? Well, we're going to hit some sort of turn in 2024. We have election season, we have student loans kicking in, we have debt at an all-time high as far as credit cards are concerned. Car values haven't dropped that dramatically, but interest rates are still in like whatever they are, the sevens, right? So there's going to be a time where tenants are going to be looking and saying, I can only afford so much, whether I like it or not. And even though landlords or housing providers, as they're called now, might say, well, I really want my price, that may not be the case. What we've been seeing lately is California law states you can charge up to 2 times the rent for a deposit, 3 times if it's unfurnished. Out of the 56 new housing laws that Newsom passed, there was some caveats to that. In other words, max of 1 month's equivalent. That was generally geared towards the institutional investors, not necessarily mom and pop. But regardless, tenants are pushing back on that. They're like, I know you want 2 months, but all I can afford is 1, right? I'm seeing a lot of bank statements come through with not a lot of money in the bank, right? Because inflation, all that. So you need to be a little bit more conservative on your numbers when you're analyzing deals, because we don't know necessarily what's to come as far as affordability is concerned. The other aspect, and that what I'm now incorporating in some of my calculations, is what is the loan buy down? I actually start to count that towards cash flow because I know that I don't necessarily intend on holding on to my properties forever, right? At some point, it will make sense to sell the property and do what's called 1031 exchange into different asset classes, right? So maybe I start building this little empire of properties out of state. That's where I do a lot of my investing now. And then I might sell off that portfolio to go buy a big apartment building, right? Kind of scaling up. So when looking at the loan buy down, that's important because it's unrealized equity because your tenants are paying it, right? The tenants are effectively paying down your mortgage. That's the whole kind of point, right? Is, kind of get a equivalent of a free property over the course of 30 years. Regardless, it does not hurt to look at the loan buy down as one of your new metrics. The other thing is, of course, looking at the laws, right? Because laws are changing rapidly. They're hard to keep track of. And if you're thinking about doing something like an Airbnb, VRBO, basically short-term rental investing, it's going to become more and more difficult because you're going to have things like new laws, right? In Los Angeles, you have to be a primary resident, max of 120 days. Yes, you can get exceptions. There's exceptions to everything, but you need to understand what the laws are in your given rental market to better understand what's going on. The other thing is really focus on what your expenses are going to be. So for property managers, for example, a lot of them charge anywhere from as low as 6% to as high as about 10% of the gross rent, but they charge you an extra fee to find a tenant. They charge you an extra fee to renew the lease. They charge oftentimes an upcharge to manage maintenance requests. So if a plumber has to go in there for $100, they might charge 5%, right? $5 or $10 if it's 10%, whatever it is. But you need to really get to understand what those costs are and calculate that all in when analyzing properties. And then, of course, the last thing is where you're going to invest, right? I'm still hearing people wanting to invest in Detroit. Nothing wrong with that, pros and cons. Some people want to invest in Nashville. Nashville's kind of become a very expensive market as far as real estate investing is concerned. And some people actually generally want to invest in Los Angeles, even given the laws that are in effect. And part of that is because they know about the appreciation. They know about the loan buy down. They're seeing the bigger picture, and they're seeing the, okay, if we can get the high turnover in some of these markets, that actually can be a good thing, right? High turnover in Los Angeles means you can keep up with the rents rather than, you know, being, we'll call it hindered from rent control, because rent control puts a cap on how much you can increase rent, but it's usually not keeping up with inflation, which can be a challenge. So I'd love to hear what you're going to be doing in terms of investing here in 2024. Go ahead and comment below. Don't forget to follow or subscribe depending on where you're watching this, and you have a great rest of your day.